holding all else equal, higher inflation in any economy is bad for its currency. That's a sort of standard relationship in foreign exchange markets. But if the Fed decides it wants to raise interest rates in response to that higher inflation, then that changes things. So really, the question folds back on the Fed. How is the Fed going to treat higher inflation? Is it going to turn hawkish unexpectedly, or is it going to keep rates low? I think we should have some conviction that the Fed is not likely to respond in an aggressive way to higher inflation for a number of reasons. But probably the most important is that this is just a classic supply shock. We're learning that the economy has less supply capacity than we thought it had. And we're going to have some more inflation and a little bit less growth over the short run. We have a kind of standard playbook for that. Central banks in developed market economies typically look through these types of supply shocks when you have a lot of slack in the economy. That's what we should be looking for from the Fed here. I don't think investors should be positioning for the Fed to turn hawkish, to change their mind, to start tapering at the June FOMC meeting. We're a long way away from tapering, and we're a very long way away from rate hikes. So, investors should get used to a patient Fed, and we think that that is likely to apply dollar weakness as well.
Okay, interesting. At what point, Zach, since you have looked at the supply chain issue closely, at what point would those supply chain challenges ease, you think, to bring about some balance in the inflation trend?
Well, it's going to depend on each market segment, and it's probably going to be, shorter for some things. We are seeing, what's been well telegraphed is lumber prices coming down as supply is easing in that market. On the labor market side, it may take until September when the unemployment insurance benefits, the top of unemployment insurance benefits expire. In some other market segments, it may take through the balance of the year. So, this is our first pandemic. We are learning how the economy is going to respond to both the shutting down last year and the reopening this year. And there's probably going to be some further surprises along the way. But it is the case that short-run supply restrictions are partly behind the price increases. That doesn't mean we're not building up medium-run inflation risk, but investors should expect some of these supply restrictions to ease over the coming months and some of the most acute price pressures in certain affected segments to come down.